No, I think that our approach on guidance, as I have said before, is to make sure that what we see is what we talk about, what we say it as we see it, as one of the analysts said it today. So that is continued to be our approach, and we operate in a very volatile environment where there are the internal factors, but in particular there are the external factors and ramp downs and so forth that clients get affected to. We have approximately 1,000 clients, so the number of clients is not that large, and the top 250 of them produce a vast majority of the revenue. So anytime there is a ramp down for various reasons, even if they have nothing to do with us, you get affected by that in the near term, and it's sometimes very difficult to foresee that. So therefore you have to constantly focus on the underlying fundamentals and are those moving forward in a good way or not. And on those fronts we have been making continuously good progress. In terms of the near-term guidance, we have been affected by a couple of these ramp downs that I have talked about, and what is happening in the industry, and other our peers in the industry have also gone through a similar experience. So it is not unusual for us. So that's all I can say. I mean, we'll continue to
right. But you know, there are 3 or 4 moving parts. U.S. banks haven't been doing well. The whole, migration to SaaS. Plus, you also have pricing pressure and the uncertainty in the U.S. election. What is hitting you the most here, and what is likely to hit you the most in the next 6 months?
No, it is none of those structural things. It is just a couple of clients. Yes, in our case, that a couple of these clients have been impacted by Brexit, but I cannot say that Brexit is causing us to lower the guidance. This would be wrong. We tend to overstate the impact of external factors. It is largely internal factors that contribute to these things, and as I said, ramp downs in a few cases can have a significant impact on near-term revenue volatility and so forth. So this is kind of what we are.
Last couple of questions. Seeing where you are, you're shy of the $10 million mark now, 24 to 25% margins. Is the 2020 target still realistic? Do you see yourself buying growth in a big way? Are you prepared to take that approach?
No, we will never buy growth. We are not interested in that. Life is too short to do that. What good is an aspiration if it is not aspirational?
But again, is it an aspiration or an actual target?
No, it's an aspiration. It is what we have aspired to. I mean, it's such a steep target, and that's what makes it exciting to go after. However, our guidance and our forecast and so forth are based on what we see in the near term, where we have a better ability to handle. So, our revenue guidance is on a yearly basis, and over the course of a year we revise it based on what we see, and that's what we'll continue to do. But in the meantime, we continue to have a great approach, and the idea is not only that it is an aspiration. It is that we want that to be a consequence of the work that we do, meaning to develop ourselves into an automation and an innovation-led company, so that the profitability, revenue growth, and the revenue per employee growth all get us to that point.
Right. Lastly, the restructuring that you've announced today in the structure, how much of a distraction is it likely to be for the existing management? Was it really necessary at this stage?
Oh yeah, it is, because if you look at, we are now approaching $10 billion in revenue in the trailing 4 quarters. I think we will cross it this quarter. So that means that the 3 sales presidents are collectively handling more than $3 billion of responsibility each, which is a huge number to have a direct responsibility for in the structure that we had before. And in addition, they also have serious global responsibilities, unique ones like Mohit for operations, sales operations, and Sandeep in the new services and software, and Rajesh in consulting and design thinking. So therefore it is important to improve their bandwidth, and to a large degree we have done that from within, but we have also brought in external talent. So Sangeeta is joining us on Monday. Sanat just joined us a couple of weeks ago, and so forth. So that is how it is we are going to do it, and it is a refocusing of the restructuring of to a large degree, the existing leaders, but to give them a very clear focus on accountability and targets beyond revenue growth, in ensuring that the strategy, the mining approaches and so forth are all done. And mostly it is about improving the bandwidth of our leadership and increasing the agility and flexibility, while at the same time making sure that we have a very sharp accountability and focus. So those are not just buzzwords. It is important at a large scale for a company to operate with those principles, and that's what we have done.
Well, I think we have always said operating margin for the medium term is 24 to 26. Last fiscal, we exactly were at the midpoint, 25. And last year, what we grew at 9.1%, right? 9.1%, we had margin of 25%. The first half of this year, we have had 24.5% operating margin. And if you look at this quarter, even on the back of first and second, H1 quarter has been slower, right? The growth has been slower than last year, in fact. But still the operating margin of the first half is 24.5. Having said that, given the growth trajectory for the second half, we are saying that while we continue to focus on operational efficiency parameters, our expectation is that for the fiscal 17, it is 24 to 25. However, what we are not ruling out anything beyond, right? And at the same time, one thing to notice, automation benefits have not yet kicked in, as I was responding earlier.
Will that take you to your 30%?
I don't want to kind of hypothesize on that. However, I think all these are all the operational efficiency measures that we are doing has started yielding results in the last couple of quarters. Automation is something which has not really kind of big way impacted us on the margins, primarily because initial phase of the automation happens mostly offshore, mostly junior roles, where the impact on P&L is minimum. I think now as that gathers momentum, we have to see to what extent that can really help us on the margin. But at this point in time, it's too early to give an indication.
Right. Praveen, just one question on you, on the trends that you're seeing, geography-wise and industry-wise, anything that we should look out for this particular quarter?
I think by and large, there is no industry-specific thing.
Because BFS seems to be a pain point across the sector.
Yeah, but for us, for us, if you look at it in the last 8 quarters at least, we have done well on BFS side despite all the challenges. And if you look at the commentary of our peers also, in the past also they have talked about challenges. So despite that, we have done well. For us, the next couple of quarters may be a little bit soft, primarily because of RBS impact. Otherwise, the pipeline is decent in BFSI and we are confident. And by and large, across sectors, we have seen decent things. So we are not seeing any particular headwind. Energy probably could be the only one, but there's an expectation from January onwards, capital spending will come back to the energy sector as well. So by and large, we can't think of any specific sector, barring the overall weakness in the BFSI, but that also I think with our portfolio and a mix of clients, we are fairly confident that we should be able to continue to do well.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.